We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gareth Soloway, President and Chief Market Strategist at VerfiedInvesting.com. Thanks for joining me today, Gareth.
Always a pleasure. Thanks for having me.
Gareth, do you see the concentration of wealth in the top 6 companies in the S&P and NASDAQ as a real warning to those indexes and investors that are in passive ETFs or those companies specifically?
It is actually very concerning. And again, I think a lot of investors just kind of sweep it under the rug for now because it's working. And again, when you have 6 companies that are 33% of the S&P 500, and keep that in perspective. So that means for every dollar that goes into one of these passive ETFs that tracks the S&P, 33 cents goes into 6 companies, while the other 67 cents goes into 494 companies. And so the overallocation, it's helping the market go up, but things go both ways. And once you see these companies come in, which inevitably will, it actually could create the risk of some sort of flash crash or bigger market decline. So it is a concern, big concern.
So do you see that risk of the flash crash because of that concentration being higher, because people are just going to be, as I know you say, in a race of musical chairs to get out of that trade once that drop starts to happen? Yeah,
and I think that's the risk, right? Is that you have these bottlenecks where everyone tries to get out at one time of these names that are so over concentrated. And we know because they make up such a massive amount of the S&P and the NASDAQ 100 is that if everyone tries to get out at once, you could see literally, multiple dollar drops in something like Nvidia, Apple, and Microsoft in just a minute or even a second. And that could literally send the S&P down 4, 5, 6 to 10% in a very short amount of time. And remember, we have triggers for circuit breakers now. And so it wouldn't surprise me if something freaks the market out enough that you do see those circuit breakers tagged and triggered.
Mm-hmm. So with that being said, and the amount of people and let's say institutions that are playing those big names, is it possible that the trading algorithms have a big part to play in that as well?
I think the algorithms do. And the algorithms obviously know a fair amount. They know about the money flow. They know to kind of stay in these names. But those algorithms, they will run for the hills at the first sign as well. And again, these algorithms and computer programs, a lot of the bigger institutions have literally hundreds of billions of dollars in these type of things. And again, you could look back at the flash crash years and years ago, and they blamed it on a fat finger trader. But in reality, what it was is, people got very scared very quickly. There was some triggers in the charts that got triggered, and people ran for the hills, and it was the bottleneck effect. And this was in a period where you didn't even have close to the overallocation in a market of what we have today. And again, this by far, you can go back to the 1920s before the Great Depression and the Roaring 20s. You can go back to the dot-com era. There was never a scenario where you had this much money concentrated in such few companies.
Right. So Gareth, even though we're seeing these markets and these indexes at basically all-time highs, it would make one think that the economy is great, and investors are obviously kind of confirming that at this point. Do you think that there are other signs within the economy that are starting to show the weakness and possible reversal of this trend?
Yeah, I do, right? So, things that concern me would be something like the transports. And the transports, again, this is the backbone. You could argue that it's the backbone of the U.S. economy. And I can share my screen here. I think it's really important to kind of gauge what we're seeing here. But, one of the things that concerns me is that the transports, we can see it right here on the chart, is that you really just made a double top this year while the S&P 500 and the NASDAQ were making new all-time highs. Mm-hmm. And what we've seen in the transports is that we've seen a pretty big rollover, even though the S&P and the NASDAQ have made new all-time highs just as of the last couple of days. And so this is something that concerns me because this is an economic indicator, right? When you look at the transports, you're looking at how much trucking is going on, how many goods are being transported to be sold. And if there's a slowdown in the transports, then there's likely a slowdown in the economy. And if you extrapolate that out, you're really talking about a slowdown in the potential for consumer spending, which then that does impact something like Amazon, that does impact something like Microsoft, and even Nvidia across the board. And that can be very problematic. And it definitely impacts Apple and iPhone sales as well with this hype that we've seen. And then a couple other things that are concerning too is you look at the Russell, right? Here's the Russell 2000, which excludes, right? We don't have the $1 trillion names in the Russell. It's 2,000 stocks. It's the broadest index really of the main indexes. So it's the best gauge of the economy, you could argue. And this again, here was your 2021 all-time high. We haven't even come close to this all-time high. So again, just multiple signals that are telling us something is amiss in the system. But again, generally investors will ignore it until the overall bigger indexes start to collapse. And that hasn't happened yet.
Gareth, what about something like Airbnb rentals? Is that also telling us that this economy is much weaker actually than the broad indices, or I guess we should call them the narrow indices are showing?
Yes. The 6 companies that are the market now. That's true. So yes, and you're right about that. Airbnb, I've got boots on the ground there. Rentals for Airbnbs are down sharply in most locations around the globe, or at least in the US. And you can see it in the charts. I mean, here was your 2021 all-time high over here. This is the recent all-time, or the recent 52-week high. And then this is what we call a bear flag forming as well. And again, this is going right to consumer spending. And we've seen Disney, we've seen Starbucks. I mean, we even saw Expedia recently report, EXPE report earnings, and we can see again that had a big drop from its highs. You had the big gap here, the big drop on earnings. It has rebounded a little bit, but there's a lot of signs that the consumer is starting to be stretched more and more. And I think even recently American Airlines came out and warned, and here's the American Airlines chart, and you can see that this is down significantly. In fact, we're basically at 2023 lows, double bottom here. And all of these go to what consumers are able to afford. And remember, you have 2 classes of people now. I mean, again, just calling a spade. You have the rich who have a lot of exposure to the stock market that are still spending out there. They're still buying and they're still traveling. And then everyone else has been crushed by inflation, and they're struggling to get by. They don't have the exposure to the stock market. And so the key is that the economy right now, we see it generally still holding up. But as soon as that stock market comes back down and we see the high-end consumer pull back, it's recession. There's a recession written all over things.
Mm-hmm. So I want to talk about some of these, let's say, confirming signals. And I think we can talk about a particular group of commodities in this vein as well. Copper, for example, has had a great run to new nominal highs this year, and it's often referred to as the barometer for the world economy. So is it possible that this has been more reflecting inflation than only demand, economic activity from the world?
Yeah, I do think so. I think copper was a great example of what we would call a double top up here. You had this major high pivot right up here going back to 2022. We had an incredible run, something like, I think it was about 40% move up on copper right into that level. But since then, copper's really broken down. And I think, again, we've started to see some signals that the labor market in the US is starting to weaken. We've seen some PMIs come in showing contraction. We've seen the housing market in the US, the inventory, the amount of houses in terms of inventory on the open market now are skyrocketing, and we're starting to see price pressures coming in. And so all of these are signaling a slowdown, and they've really, this data has really started to emerge over the last, let's say, last 2 months. And that's right where copper topped out, and copper's now turning back down. So I think part of the copper run was this inflation push, but also it was partially because everyone was assuming the Fed was going to engineer this magical, safe, no landing scenario where the economy just kept going and going and going. Mm-hmm. And now we're starting to realize that probably is not going to happen. So I do think in general, copper's getting close to some technical support. But if we do slip into a recession by end of year or early 2025, copper probably has more downside. And same thing with oil as well.
Mm-hmm. Well, I was actually going to ask you if we could look at the oil chart as well, Gareth.
Yeah, absolutely. So what we have on oil here, and I'm going to flip over here and remove a couple of these trend lines just to keep it simple, is you have oil that's kind of continuing to hold steady right off of these recent lows. I did read that there were a majority of hedge funds, or a ton of hedge funds, were short oil. Anytime you have hedge funds that are heavily short anything, generally it's not going to drop because there's too many players on that side of the playing field. So in this case, we've seen a rally in oil, but we are kind of right up into this level here where if we zoom out, we can see again that oil going back to the lows from COVID, there's this trend line, and we broke that trend line here, and we've now retraced into resistance. So there's a lot of resistance on oil up here. And I think the key is going to be is that the U.S. produces so much. We know that OPEC is now kind of letting a few more barrels come on the open market. If you combine that with China's weak economy and the U.S. weakening, you probably have a recipe for much, much lower oil as well in the coming months and maybe the next year.
Mm-hmm. So Gareth, as we're talking about these two kind of, again, barometers for demand of everything that the world needs, how do you see the inflation picture playing out, going forward here? We've seen, basically prints that are expected or just below what is expected. So, do we see in the charts even, or, in your opinion, rebounding inflation, or is that somewhat curtailed as well? Because, and we'll get to what the central banks are doing kind of in response to that, but like, how do you see the inflation picture going forward?
So originally, back when we were at 7-8% inflation, I was saying that, listen, we'll fall to 3% and then we'll start to kind of stabilize and hold around 3 to 4%. Mm-hmm. We've done that. Now, the bigger is as the economy slows and the consumer continues to pull back, do we see inflation coming back to 2%? And honestly, I do think that does happen. I do think inflation eventually goes down just based on the U.S. entering a recession and the consumer just being stretched at this point. But one of the things that I think is going to occur is that the Federal Reserve, as soon as, honestly, they'll probably cut even before we're at 2%. But when they start cutting aggressively as we near 2%, my guess is it's going to cause a rocket ship back up of inflation much faster than in the past. And so even if we do come back to 2%, my guess is within a year of that, you see inflation back above 3%. And I don't think we're in this period where you have the olden days where we could be at 2% and stay at 2% for years or even decades. I think that, again, we're in a much more trigger-happy environment of inflation where we're now going to see that a drop in interest rates is going to kickstart inflation much, much quicker again to the upside. And that's my big fear, is that we're now in a cycle where things are happening much, much faster, where inflation will go up very quickly, and it's going to put the Federal Reserve on their heels in terms of not being able to rescue the economy like they used to.
So why is that, Gareth? Is that because if rates come down, that is a very, demand-driven event where everybody goes back right away to the cheap credit or cheaper credit than the relative highs that we've seen for the last, over a year here because of that curtailment of demand?
Yeah, so I think it's part of that. It's part of that. It triggers the high-end wealthy to really be able to make even more money, even if it's not necessarily the stock market going up, just the savings. I think there's close to $1 trillion in generated income from savings accounts at this point from the wealthy. And so there's just this constant flow. If rates go up, then they make a lot on bonds by buying bonds. And on savings accounts, if rates come down substantially, the stock market gets a big bid. And there's this back and forth of the rich can position themselves wherever they need to try to make a lot of money and continue to spend. And I think, again, we've seen the economy where we're now at a point where if you look at McDonald's, right, people that, used to be that the poor would eat at McDonald's, right? Now they can't even afford to go to McDonald's. And even the middle income spend a lot of money just going to McDonald's. We've seen bankruptcies from Boston Market to Red Lobster potentially, and all these other kind of low-end, middle kind of income restaurant chains that are really, really struggling because people just can't afford to go out to eat. And so that's part of it. And I also think that the risk with things is that as rates come down, the U.S. borrows more and more money. So there's this side of where it's consumer driven, and then there's this side where it's also government driven and Federal Reserve driven, and where the Federal Reserve's balance sheet is ultimately going to go higher. It's come down a little bit from its peak during COVID, from about 9 trillion to about 7 trillion. But on the next crisis, it will probably go to 15 trillion. The U.S. debt is going to probably go to 40 and 50 trillion. And at some point, that's going to have this bigger detrimental impact not only on inflation, but also on the amount of rate cuts that can be done before other countries just say, hey, listen, we're not going to buy your debt anymore. There's no chance of you paying it off. So there's so many layers to it that is honestly pretty fascinating. But the course that we are on as a country is freaking not good at all. It is scary, to be honest. Just as someone in their 40s and I have kids, I mean, it is not where I want it to be for my kids when they grow up.
Mm-hmm. Gareth, as we're talking about this idea of the amount of debt that is out there, how do you think that all ends up coming to a head? Is it, you explained that other countries aren't going to want that debt anymore. I saw a story over the weekend that China liquidated something like $53 billion worth of treasuries the other day. So, how do you see this playing out? Obviously, understanding that, neither of us have a crystal ball. And right. This is, as you said, there's so many pieces, so many chess pieces on the board, if you will.
Yeah. So my biggest fear is that at some point there's going to have to be a financial reset where, all these countries that have just printed and taken on massive amounts of debt to GDP, there's some sort of collapse that it creates the birth of some new sort of financial system, some with checks and balances where governments have to have a balanced budget by law, stuff like that. But it does bring up the question of, number one, physical metals having a bigger role in the future, and then also cryptocurrencies and things like Bitcoin maybe having a bigger role as well in terms of backing the US, right? I mean, imagine if there was, maybe this is where the CBDC comes into play too, where it almost rescues the financial system, but it rescues it with predetermined expansion to it, right? So for instance, imagine if the monetary supply was only allowed to expand, let's say 2% a year versus the government being able to just print ad nauseum, or the Federal Reserve being able to print ad nauseum. So my guess is something like that will occur. The problem is to get to that point, we are going to have to go through something that's very akin to the Great Depression. And I worry it could be even worse than that. And so, there will be a lot of growing pains. And this is what I've always said about the Federal Reserve intervening, is that in general, it creates a scenario where you don't allow the natural course of economics to play out. Like if you look at cycles, the seasons, the solar cycle, the lunar cycle, everything has a cycle. We all have cycles in our lives, that we abide by. We go to sleep, we get up. The economy has a natural cycle. It has expansionary periods and contractionary periods. When you don't screw around with the cycle, the expansionary periods are solid. The recessions are lukewarm. They're not horrible. When you mess with the cycle and don't allow recessions to occur because you print right away and you just lower interest rates, then when we do get one, it's 10 times worse. Think about it like this. If someone never got sick and they were kept in a bubble, and all of a sudden they were removed from that bubble, they would get so much sicker because their immune system was not actively made to combat those issues. Mm-hmm. And that's now what we have in this financial system, and really globally with many countries out there.
Mm-hmm. I just want to go back to what you touched on with the CBDC. Do you think that ends up being, almost like a Band-Aid fix on top of this already fragile house of cards? And, after experiencing what you said is maybe a Great Depression that brings on that CBDC, that after that, we have to almost experience another one to really flush out, clean the system out, and get back to an even more sound form of money, whatever that ends up looking like?
That's a good question. I think that when things collapse, if it does cause something like the Great Depression, there's very few people that are alive now that have experienced or gone through the Great Depression. And I think that is what they always say is, every generation has to experience it. So we're kind of at that cycle turning point where you almost have to expect it within the next 5 or 10 years. But I think the uproar from citizens of the world, and that's the US and probably Europe and the rest, what we're going to go through will be so blatantly obvious that it was mismanagement from the Federal Reserve as well as the government that I would hope, and I say hope because you just don't know, but I would hope that the demand from people will be such that the curbs will be put in to make a system that is actually solid. So I'm hopeful that we don't have to go through two of them. But just like always, in 100 years later, it is have the rails come off. Like I remember vividly when going back to 2008, 2009, banks were failing and Dodd-Frank was introduced and they were like, we can't have any banks that are too big to fail. We can't have any companies like that. We can't go through this again. And here we are with banks that are even bigger and more leverage in the system. And heck, now we have companies like Apple, Microsoft, Nvidia that I guarantee are too big to fail as well. And so it shows you how short-term people think. People forget things so fast. And so you're right. Maybe we have to go through it multiple times before it truly is fixed.
Mm-hmm. As you're talking about, the Federal Reserve and its actions to really postpone this pain that needs to happen, how hard do you think that is going into this election cycle, going into this time period where everything they do is extra under a microscope? And we have this scenario where they are trying to be, or they claim to be, apolitical, and they really have this balancing act of, not trying to push the market one way or another, even with just their words, even if they don't change policy, but even if it's just the verbiage that they use. How difficult is that going into this election cycle?
Yeah, it's very difficult, right? I mean, I think on the positive side, the data up till this point has kind of allowed them, right? Inflation stayed a little higher, so they can say, oh, we can't cut rates yet. And at the same time, the economy's staying relatively strong, so they don't feel the need to. I did see Neil Kashkari over the weekend coming out and saying we won't cut rates likely till December. Mm-hmm. And again, that perfectly puts it after the November elections. But the question I have is, well, what if the stock market collapses 10%, let's say over the summer? Are you really going to hold back to that? What if we start to see unemployment skyrocketing? So I think they want to try to remain neutral because, needless to say, especially here in the US, everything is so polarized at this point that no one wants to step in the middle of that. So they would prefer to wait to December. The question is, are they going to be able to? And if they, this is the kicker, is that even if the data shows that they need to cut or they do cut, it will be made into a political thing if it's done before the election, because that's just the way our media is and our system is at this point. But I truly believe that they don't want to mess with that. I mean, if they're like me, man, you just want to stay out of that whole mess. It's just a nightmare, to be honest.
Mm-hmm. Do you think that the rest of the central banks in the world have started this rate cutting cycle, and the US in some ways has won because everybody else has capitulated before them?
Yeah, it is really interesting. I know with Canada cut rates recently, as well as the ECB, and it is interesting to see these other countries already starting to move that direction. It's probably because their economies are showing a little bit more weakness than ours, and there might be more stresses that they're seeing in the system. But again, it's one of those things where every time some other countries cut rates, it does make it easier for the U.S. to say then, okay, well, now we have to compete essentially, and therefore cut rates. So I think that's just the beginning of the ability for the Fed to start lowering rates later this year.
Mm-hmm. Gareth, you were mentioning these banks that were too big to fail. Do you think that the risk of this duration mismatch of a bunch of the assets that we saw blow up last March 23 is still a risk here in the banks in these markets?
I really do. This is, I've heard rumors recently that the big players like JP Morgan are unloading some of their bad debt because they know what's coming. But basically you have a scenario here where in a weird way, it's almost worse. It's different than 08, 09. In 08, 09, it was people's homes that really dropped so significantly where they had taken out zero down payment mortgages and stuff like that. In this situation, it's more with interest rates where they are. A lot of these mortgage-backed securities were priced and put together when interest rates were 2% or 3%. And so there's massive losses sitting on these banks' balance sheets to the point where I call them zombie banks, right? If the Fed didn't bail out or the FDIC didn't bail out the depositors, you would see more bank runs going on. But the bailouts of those depositors kind of calm the nerves. Everyone now thinks, hey, don't worry, you'll get bailed out no matter what. So that creates these zombie banks that can still operate even with massive losses. And then here we have incredible losses looming on the commercial real estate side. I mean, you go to strip malls, you go to malls, you go to various things. There's like 50% vacancy rates where there's so much dead paper there that's at down 60, 70, 80%. But again, as long as they hold it to maturity and there's no hiccups along the way, meaning the economy stays strong, they can kind of weather these storms. But again, one sort of blip one sort of black swan event, and this all comes crumbling down. And again, some of the losses are rivaling what we saw in 08, 09 in terms of what they're holding. It just hasn't had a trigger yet to cause a collapse.
Well, I think that in a way that's almost proportional, right? 08, 09, the debt wasn't as big, the leverage wasn't as big, the derivatives weren't as big. So, I mean, absolutely point taken about these losses, but the magnitude of the financial system or the magnitude of the bubble is so much bigger, right?
It is so much bigger. And again, it's one of the fears that we talked about just earlier, is that every time the Fed gets involved, it allows bad actors to say, well, they saved us again, so why should we worry about the risk? Let's just take more leverage, more risk. Mm-hmm. And at some point, the Fed does lose control. There was a point in 08, 09 where the Fed did lose control. And I still remember they would come out and say things, and the market would initially bounce huge, and then it would just go down and dive another 3, 4, 5% on the day. And so there is a scenario where you get the Fed to lose control. And then with that type of leverage in the system, it would be a global credit event of proportions that none of us can even fathom.
So is that, this global credit event, Gareth, do you think that is the biggest risk to the markets right now, in your opinion?
I think that that's the biggest hidden risk that no one's talking about, right? I mean, and the question is then what causes it? Is it China invading Taiwan? If that happens, is it the U.S. economy starting to crumble and the backbone of the U.S. economy, which is the consumer, finally stopping their spending because they can't deal with the inflation pressures? Or is it something with Russia and Ukraine? I mean, there's so many different potential risks here. But all it will take is one or two of those, and then once you get players to really pull back really pull back from being involved, that's when the house of cards starts to come down. And again, I'm not going to pretend to know when, right? I mean, I don't know if it's in a week, a month, a year from now, 5 years from now, but it's one of those things where inevitably it will, right? There's just, you can't avoid the pitfalls forever. And the longer it takes and the more money in the system and the more leverage taken, it's going to be worse and worse.
Mm-hmm. So is that why, you're looking at the precious metals, as you said, and some cryptos to offset that, part of that plunge or part of the pain from that plunge?
Yeah. And in all fairness, I mean, there's nothing that says gold won't drop if all panic lets loose. We saw that in COVID, right? Initially, gold dropped as well. But it's more that having that something physical that stood this test of time, like gold, silver, platinum, palladium, these precious metals, there's something to them that people have held on for, generations, that there's value there. And then with, to be honest, I wouldn't really mess around with anything but Bitcoin, but in terms of that kind of side of things. But I do think that more and more so that gives us an alternative to the printing of money, where you have a stated run on Bitcoin. And so again, it's all about diversifying, right? We buy life insurance, we buy health insurance, we try to diversify out of risks. Well, people have to do the same thing with their financial health and make sure that they're diversified, so that if anything happens, you can say, okay, well, I lost 80% over there, but I still have 90% over here. I'm still okay. And again, the crazy thing is that if we do get a credit event like that, you would assume that even if gold dips initially, it would skyrocket afterwards and then really make you whole again. And that's why diversification is so important.
Mm-hmm. Could you walk us through the gold chart, Gareth?
Yeah, absolutely.
Maybe the gold and silver chart?
Absolutely. Here, let me bring up my screen again and we can take a look. Gold is having a small down day. So interestingly enough, I want to show you guys this on the monthly chart. So if we flip to the monthly chart, I want to show you where gold stalled. So we all know it broke out above 2070, 80 or so, and had an epic run over 2,400. If we take the high from 1980 right here, and we connect it to the highest point here in 2011, and we stretch that trend line out, we did pierce the trend line. But if we zoom in, look at how we never got a daily or a monthly close above that. And I think that's so fascinating to look at how a line going back to 1980 actually capped short-term price. So for me, I look at this and I say, okay, we might have a little bit of consolidation to go, where gold needs to just consolidate, maybe pull back just a little bit. But flipping back to the daily chart, if we get rid of this, I think that again, you basically start accumulating somewhere in this vicinity. There's a lot of support around 2185. And then if we ever get back, I mean, this would be a dream If gold can get back to about this 2070 level, this is what we would call the scene of the crime where it broke out. That would be a huge accumulation zone. So I would say this. Short term, I still think there could be minor pullbacks here, little pullbacks, just people digesting the recent move up in gold. But I think mid to long term, gold has $2,800, maybe $3,000 written all over it over the next 6 to 12 months.
And then what about silver, Gareth?
Sure, absolutely. So if we look at the silver chart, silver had that amazing breakout above 30. It didn't hold, which is a little unfortunate, but it's in this bullish channel right now. And so I'm still a favorable investor on the side of silver. I still think it may come down just like gold a little bit more, but eventually it breaks out for its next leg up. And I think really what you can do is you can go back to, if we go back all the way and look at where this was trading in 2011 or even the double top, and it's really a double top, you got to think that in the next year or two, with the drop of rates that's probably coming from the Fed, with the printing of money, with the U.S. debt, you got to think eventually silver retests that $50 level in the next few years as well.
Gareth, are there any other metals that you're interested in? Maybe palladium, and why is that?
Yeah, absolutely. So I do like palladium. It hasn't performed well, but that's one of the reasons why I like it. So for me, I don't care so much about the industrial use case, which is partially for palladium. Same thing with silver, right? Silver and platinum. For me, it's all about the rarity of it and where it's trading on the chart, if there's an opportunity there. And with palladium, like you're talking about going back to levels back here in 2015, 16, and 17, that was the last time we were trading at these current levels. And if you look at the amount of debt that the U.S. has taken on, the amount of printing and the balance sheet of the Fed, the amount of M2 money supply in the system, to me, this looks very inexpensive when you look at it on a diversification away from fiat currencies type scenario. So again, is it possible we could come down to this lower line, maybe below 800? Yes. But in terms of comparing it to gold versus palladium kind of looks like a better deal right now where it's trading. And the other thing to point out is that I believe palladium is about 30 times rarer than gold as well. And so you do have that rarity factor, even though gold is the one that everyone loves and, jewelry, a lot more jewelry is made out of. Palladium on a rarity basis is actually pretty special.
Yeah. And of course, I know you guys recently posted an article on your guys' website about just different facts of the precious metals, and I'll repost that on Twitter.
Awesome.
Quite interesting stuff. But this kind of reminds me almost of let's say the natural gas chart a couple weeks ago or a couple months ago, where it is, an excellent time to be seeing these lows and recognizing that as, it's not that it can't go lower, but the risk to reward is pretty favorable in that case.
And I think that's the key, is the rarity of it. If you're buying it, for me, if I'm buying palladium, I'm buying it to offset the risk of fiat currency printing to ad nauseum, right? You assume that for every 10% and more money that is printed, you would assume palladium would offset in terms of its value by going up. So it's a way to store value. And I think that for me is what makes me very interested in something like palladium at these levels.
Absolutely. Excellent, Gareth. Well, I really appreciate you running us through all these charts, all these ideas today. Is there anything you want to leave our listeners with before we wrap up?
No, just continue to be vigilant. Do your research. Look at charts. Get unbiased chart opinions. I love charts because of that. Is that they don't have a narrative, right? They don't have an agenda. Its chart is a chart, and so just take a look there and check us out at verifiedinvesting.com. That homepage has so much quality free information on it. It's really a go-to for so many investors and traders.
Absolutely. And of course, on Twitter, you can check them out as well at ITMS and at Gareth Soloway. Gareth, thanks so much for your time today.
Thank you so much for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.